Good morning and welcome to the Killik & Co market update. It's been another strong week for markets following the release of some US data that showed a further fall in inflation. As we've talked about in a few recent videos, larger companies have recovered well from the market crash of 2022 and they've moved above their previous highs. However, smaller companies have continued to lag behind. However, there are some recent signs that enthusiasm might be returning for investing in small and medium-sized companies. On this chart, we're comparing the S&P 500 larger companies in the green and the Russell 2000 smaller companies in the pink. You can see the Russell is still well below its 2021 peak, but it has had a strong run since late last year. We've been having a look at the average valuations of these two indices and how these valuations have changed over the last year. A year ago, the average price-to-earnings ratio of the S&P 500 was 17.82. A week ago, it was 23.01, showing that it has become more expensive. The opposite is true of the Russell. A year ago, the average price-to-earnings ratio was 42.31, and a week ago, it was significantly cheaper at 28.27. This week, the latest GDP data for India was published, showing economic growth of 8.4%. To put that into context, the equivalent figure for the UK was just 0.1%. Here's Indian GDP growth over the last decade. With the exception of the COVID drop that virtually all economies experienced, the growth rate has been above the 8% level for much of the decade. The Indian economy is now the fifth largest in the world, ahead of the UK. India now has an 18% weighting in the MSCI Emerging Markets Index. Here's the breakdown. You can see India is not far behind China, which accounts for 24.9%. Therefore, if you have an emerging markets tracker fund, you will have a reasonable level of exposure to India. Following the release of India's GDP figures, the Indian stock index moved to a new record high. Here it is over the last 10 years. Investor interest in India has been growing of late, as many firms have been moving their manufacturing away from China to India. Apple is one example, and Google has also just announced that it's going to start producing its Pixel phones in India. And finally, St James's Place has been in the news this week after announcing it has set aside £426 million for potential client refunds after the wealth manager received complaints from clients who have been charged but who believe they have not received a sufficient level of service. For example, many of these clients have been charged but believe they have not received an annual review from their wealth manager. Shares in St James's Place have lost more than 2/3 of their value since 2021. A new regulation called Consumer Duty was introduced last year, and it's a far-reaching and detailed piece of legislation, and it places greater onus than previous legislation on how wealth management firms should provide fair value to consumers, how they should provide clear information about their products and services, and how they should be recommending suitable products and services to their clients. We'd be very happy to answer any questions you may have about Consumer Duty. Moving on to have a look at next week, we've just got two clients reporting from our covered list, Costco and Deutsche Post. That's it from us. Have a great weekend, and we'll see you next Friday.